Ronaldo's legs, for example, might get insured. So,
that's a good example. So you're gonna insure Ronaldo's legs.
I've never priced a footballer's legs or guitarist's fingers or singer's voice or any of the other things.
What is actuarial science? And why is it that so few people decide to pursue this as a career?
So actuaries do a wide range of roles, but it's almost always to do with risk.
How do you price it in for a market like this, that is, let's say, Pakistan, versus a market like the US, where things are pretty certain and you can predict out into the future, into the foreseeable future?
If you buy a government bond in the US, you're pretty sure you're going to get your money back.
What is the range of risks that are often considered to be sort of the standard set of risks that you would look at for any business application?
There's no exactly correct categorization. The most important thing is everybody that you're talking to has the same view of the categorizations.
With the sort of proliferation of AI, doesn't this put actuaries out of a job? Because, I mean, the data is all digital.
The number of actuaries hasn't shrunk, it's grown. Because the more tools there are to do the job, and the more data there is as well to work with, the more you need people who actually understand exactly what's going on.
Is this a career that becomes boring after a while?
It depends what you want. Some people do want a routine career which isn't too stressful and they do the same thing time and time again.
What's the one thing you don't like about this career?
I once ended up in a pure client service role where my job was to put together presentations on performance numbers and take them to clients, and I hated it.
Did you know that actuarial sciences is probably one of the hardest academic programs out there? And did you know that they actually used to have only 1 pass and 5 grades of fails? So you could get an AF, a BF, a CF, but you'd still be a fail. Well, because I've learned about this, I was so curious about this particular career path that I decided to look for an actuary. And one stumbled into my path, and I invited him to the show. He's actually visiting from out of town. His name is Paul Sweeting. He is also the president-elect of the Institute and Faculty of Actuarial Sciences in the UK. He's going to talk to us about risk and how to calculate whether risk will affect you negatively. And check out this episode of DigiTales right now. Paul Sweeting, how are you today?
I'm very well, thank you.
And have you enjoyed your trip to Pakistan?
It's been fantastic. It's been incredibly welcoming. I've had some great meetings. Very much looking forward to coming back again.
What was the one thing that really stood out for you during this trip?
It really was how generous and friendly and welcoming the people have been here. It's been wonderful.
And so you're here because, your position as a president-elect of the Institute and Faculty of Actuarial Sciences, sort of in an environment where there's a high risk. This is a high risk environment for everything, for business, from an economy standpoint, from a security standpoint. And the whole role of an actuarial science expert, or an actuary like yourself, is to assess levels of risk and model risk. But I'm not the expert on this subject. That's why you're here. So first of all, just help me understand, what is actuarial science? And why is it that so few people decide to pursue this as a career?
It's kind of like the question that you dread getting when you go to a party. Oh, you're an actuary. What is an actuary? It's like, it is so actuaries do a wide range of roles, but it's almost always to do with risk. So you're looking at trying to identify risk and uncertainty. You're trying to quantify it, and then trying to look at what the implications might be and trying to see what you can do about it. So the Institute of Actuaries, which is one of the predecessor bodies of the Institute and Faculty of Actuaries, that's the oldest actuarial body in the world. It started in 1848. And at that time, risk was basically life assurance companies. So it was, if you take out life assurance, how much do you need to pay for it? And for that, you need to know how likely people are to survive and how much money you need now to pay out any payments at some point in the future. So again, you're trying to identify risks and put a number on it. And then we branched into the world of pensions, then into non-life insurance like motor and property insurance. Now we look at areas like banking, enterprise risk management. So anything where there's uncertainty and you need to work out what's the price of that uncertainty? Then you tend to find actuaries get involved.
And when you think of uncertainty, we're in a market where there's a lot of uncertainty. How do you price it in for a market like this, that is, let's say, Pakistan, versus a market like the US, where things are pretty certain and you can predict out into the future, into the foreseeable future?
Well, it depends on the context that you're looking at, because there's certainty in the US in some things. So if you buy a government bond in the US, you're pretty sure you're going to get your money back.
Right.
But if you buy, say, a 20-year government bond in the US and then you sell it tomorrow, you don't know how much you'll get for it if you sell it tomorrow because interest rates move. So there's still uncertainty in that market. And if you're buying US equities, there's uncertainty in those assets because you buy it for something today. You don't know what the dividends you'll get will be. You don't know what the price will be. If you're looking at uncertainty in less developed markets, then you potentially got the risk that if you buy a government bond, the government won't pay the money back. If you buy a corporate bond, you've got credit risk. You've also, in less developed markets, you've got risks around liquidity. So you buy something today, you might not be able to sell it tomorrow. There might not be a market for it. So you've got liquidity risk as well gets factored into it. And these are just the financial risks, the investment risks. I mean, there's a much broader spectrum of risks, and with all these things, it depends on what risks you're most interested in, what the context that you're operating in is, what you're trying to do.
So for every application, for every situation, there's a different set of risks that you look at and model out. Is that the right understanding?
Yeah, I mean, you basically you try to work out what am I trying to achieve here. So if you're going back to the earliest example, like a life assurance policy, what am I trying to achieve? Well, I'm trying to work out how much money I need to take from all of these policyholders such that I can pay out the insurance benefits when they come due. So around that, you're thinking, okay, how long are these people likely to live? And that can get quite in depth. You can be looking at life expectancies for people within a very particular area, not just how old they are, whether they're male or female. And then how much do I need to put away now to make sure I can meet those benefits? And that's based around what interest rates are, because that tells you how much you can earn with certainty. But you might say, well, what if I invest in something else? What if I invest in equities? What additional risks am I taking, and what additional returns might I get? And then there might be uncertainty over the level of expenses you'd have. And there's a whole load of operational risks as well. You know, what happens if the systems that I'm using to make all these calculations, what if there's a problem with them? What if there's a problem which means I can't make the payments or collect the payments when they're due? So you'd be looking at it from a very high level, from a very holistic level.
And what else? So let me first break it down. In terms of potential risks, what is the range of risks that are often considered to be sort of the standard set of risks that you would look at for any business application? Okay,
well, I'm just on the third edition of my textbook, Financial Enterprise Risk Management, and that looks at these kind of questions. And that's currently running at about 730 pages. So, so let's try and narrow it down a bit.
So if there's categories of risk.
Sure. So when you're looking at categories of risk, and this is something which actuaries, including myself, have a real temptation to do, is to try to categorize everything. And it's important to recognize that there's no exactly correct categorization. The most important thing is everybody that you're talking to has the same view of the categorizations. But some common ones might be investment risk. So how much does stuff move around?
Right.
Interest rate risk is a risk within that. Credit risk, sometimes regarded as a type of investment risk, but often regarded just as what's the risk that I lend some money, I don't get it back again.
Right.
Operational risk, so all the nuts and bolts from systems and processes, but also through to, what happens if the building that you're working in gets flooded and you can't get in there anymore. So all of these nuts and bolts type risks. Longevity risk, which is usually the risk of people living longer than expected. Mortality risk, which is the risk of people not living as long as expected. Those are the ones you'd have around annuities. But if you're looking at, say, non-life insurance, then you've, say, car insurance. What's the risk of a crash? How big a crash might it be? What's the risk of injuries from that crash where you might need to make payments from? So it's very context dependent.
What is an unusual application of actuarial sciences that you've come across?
Actuaries get involved in pricing at Lloyd's of London, and Lloyd's of London is where most of the difficult to price risks go. So you have things like, Ronaldo's legs, for example, might get insured. So,
that's a good example. So you're gonna insure Ronaldo's legs. The insurance? No, you're not.
Not me personally, but someone might.
Someone might insure. So the club might insure his legs.
Yeah,
and someone has to price the risk. Then they have to price the premium and the payout.
Yep.
There's three things I'm assuming.
So you'd insure it. You'd say, I want his legs insured for how many $1 million. And then they'd say, what's the premium on that? So you do some calculations, look at the likelihood of career-ending injuries or whatever, and you come up with a price.
But how do you think about the variables in that situation? Because it's got to be an extreme, bizarre set of variables. Like he had a boating accident, somewhere off of the coast of Mykonos or something.
So if you haven't got exact information on the person you're looking at,
right,
you look at the next best thing. So for that, and I've never priced a footballer's legs or guitarist's fingers or singer's voice or any of the other things that often get priced at Lloyd's. But you'd say, okay, let's look at the population of footballers. How often do they get injured on average? How often are those injuries career-ending, or how long do they last? And you'd take as much relevant information as you could, and you'd use that to come up with a judgment as to what kind of premium you'd want to take for insuring that risk.
Interesting. How do you look at country risk?
There's different types of country risk, depending on where you are. So some of them are rewarded and some aren't rewarded. So if I am, say, a pound sterling investor and I'm investing in US treasuries, there's a risk there from the currency. But I wouldn't expect to get rewarded for it because US investors, there's no risk. So I'd see it as a risk, but I wouldn't see it as a risk where I'd expect it to be a premium. If I was investing in the debt of a country which had a high risk of default, then I expect to get rewarded for it because everybody's exposed to that risk, and the country would need to pay a higher level of interest to compensate for that risk. Now, as it happens, a lot of these risks are actually pretty well priced, because if you look at the price of, the easiest thing to do is if you've got a country which issues its bonds in US dollars, even if there's credit risk in that country, you look at, say, the yield on a one-year bond from that country, you look at the yield on a one-year US Treasury, the difference between them tells you how likely the market thinks that bond is going to default. Plus a few other things as well, the fact it might be less liquid and stuff. But that's a pretty good indication of what the market thinks the risk of that country is. And that's usually, not always, but it's usually the best source of information on some of these risks is, what does the market think?
Right.
What's the pricing of various securities like? Can you see spreads in there which might give you an indication of the different level of risk across different countries?
Right. Interesting. And so when you look at all of this modeling, there's a lot of data that goes into this, obviously.
Yep.
There's a lot of calculation. And then there's the analysis of that. And then there's the interpretation of that data. And then there's using of judgment to figure out the premiums and the pricing and so on.
Yep.
One of the biggest sort of questions I have around this is, with the sort of proliferation of AI, doesn't this put actuaries out of a job? Because, the data is all digital. You put it into the right kind of models that are built for this, they will build this out within seconds. And they will only get better, because today is the worst that it'll ever be.
So in my first job, which was towards the end of the last century, they used to have this display of mechanical calculating machines there, where you had to turn dials and turn the handle down and did the calculations for you. And before that, there were slide rules. And then you got desktop calculators, and then portable calculators, desktop computers, laptops, mobile phones that are way more powerful than the computer that put the man on the moon in the first place.
Mm-hmm.
There's always been developments, always been improvements. But the number of actuaries hasn't shrunk, it's grown. Because the more tools there are to do the job, and the more data there is as well to work with, the more you need people who actually understand exactly what's going on. And, if you go back to, trying to put a premium on insurance for Ronaldo's legs.
Yeah.
I mean, most AIs, I think, will struggle with something as random as that. It takes quite a bit of judgment. So I think because of the amount of judgment you need for a lot of this work, that's going to take actuaries. But as well, there's a huge range of tools that you can use to do this kind of analysis. And it is very easy to implement a lot of these tools. It's like a few lines of code in R or Python or something. It's not actually that hard.
Yep.
But when you're doing that, do you understand what it's doing? How do you know whether the answer that you're getting out is sensible or it's garbage? How do you know that the data that's gone in there has been properly cleaned and is as relevant as it should be for the question that you're looking at? Well,
you're building the algorithm, so you have that level of control while building the LLM in itself.
But who's building the algorithm? And even if you build the algorithm, you will probably know the situations where you can trust it more and the situations you can trust it less. So for a lot of and I'll give you an example which I use quite a bit. I mean, when I started as an actuarial trainee, I would take reports up to the senior partner and he'd read through them and he'd get to a number and say, I don't believe that. That doesn't look right. And you'd think, how can you say it doesn't look right? You go away, you check it, and they're right. You've made a mistake.
Yeah.
And then when you become a more senior actuary yourself, people bring you reports and you're reading through and you say, that doesn't look right. I don't trust that. And it's because you know what's going on underneath. You understand the process. You understand the algorithms that are there. And you know what a right answer should look like. You know what kind of sounds sensible. And I think a lot of the machine learning techniques in particular, you can implement them, you can get answers out, but unless you understand exactly how they work, what they're doing, what the maths is behind it, it's very difficult to take a view on whether it's giving you a sensible answer or not. So I think there's a key role for actuaries there. And you look at the volume of data which is being generated at the moment, which needs analysis, which can be used in a huge range of ways. You need people who are doing that analysis that understand the context, that understand the methods that are being used, that understand the nature of the data in a way that can be quite difficult to automate. And I think that's where actuaries come in.
Mm. And so if you still need that human intervention, and you have said that the number of actuaries has increased over time, but then so has the population. As a percentage of the population, do you think that actuaries have increased over time? And why is it that most people do not pursue this as a career path? They'll stick to the standard chartered accountant or the basic finance roles and not really get into this side of it. What makes it so difficult?
I'm not sure how it's grown relative to the population. I think it depends on the population that you're looking at, because it's grown hugely, and a lot of that growth has been as actuaries are working in markets they weren't working in before. So, around half of the membership of the Institute and Faculty of Actuaries, which is based in the UK.
How many members does it have?
About 32,000.
32,000 members.
And about half of those are based in the UK, but about half are outside the UK now. And so there's been a large growth in actuaries working outside the UK. So why aren't there even more actuaries?
And if I were to take the total population of actuaries in the world, how many do you think that'd be?
It is probably north of 100,000. So
it's less than 500,000.
Oh yeah, definitely.
So it's north of 100,000. So as a percentage of, let's say, even college graduates, it's a small fraction.
Yeah.
And we've had a proliferation of colleges, higher education institutions. If that is the subset if that is the set I would use for this to be a subset off of, because you need a basic minimum college degree, and typically you'll probably go to No.
I mean, it's helpful. Most people do have college degrees, but right. I know actuaries that have gone straight into actuarial work from school and haven't done a degree. So, the main challenge on that is at 18 years old, do you know you want to be an actuary? At 18 years old, have you even heard of actuaries?
Right.
So, that's one of the main barriers. Who's heard of actuaries?
Right.
After this podcast, many more people will have heard of actuaries, so that's great. But, people won't necessarily have heard of the actuarial qualification. Whereas everybody's heard of accountants. It is hard. The exams are difficult. So,
what makes them difficult?
Just a few anecdotes on them. They don't do this anymore. But when I was doing the exams, you had one of 5 grades. You had a pass, an FA, FB, FC, or FD. So they graded the fails, but not the passes. That's how difficult
insane.
These exams were.
Wow, I've never heard of that.
Yeah, well,
so
they don't do it anymore.
So you could be a top failure, basically.
Yeah. Well, it was even more galling. You knew that you had failed by less than 5%, and maybe if you just worked a little bit harder, you could have got that exam. Oh, wow. So an awful lot of people, many people fail the exams because they are difficult, but they're difficult in different ways. There's 2 kind of groups of the exams that you do. There's the early group, which is more theoretical, and then there's a later group, which is more practical and based on different practice areas. And the way I characterize it is that the first lot of exams, what you're trying to do is you're trying to work out what the answer is. And even that is pretty difficult because it is very technical stuff. It's pretty high-level maths, which makes it challenging in itself. But, you're trying to work out what the answer is. The second half of the exams, you're trying to work out what the question is. So,
how do you do that?
Well, experience, basically.
Right.
It is you can't usually pass all the exams without having built up a reasonable amount of work experience and just on-the-job training, which gives you a sense for what the real question is. So, there are many of these papers where you'll have a 40-mark question, and the question is in 2 sentences. So you have to read the question and say, okay, what are they really looking for here? What's the real question? Which bits of the syllabus, which bits of my knowledge and experience do I need to draw on to answer this question?
Sounds exactly like a brand brief from a client for a marketing agency.
It
like, what is it that they really want?
Exactly.
They've spoken nonstop for the last 10 minutes.
Exactly. So people, and it's the same in actuarial work. If you're in consulting, say, a client might come to you with a question,
right?
But you have to say, okay, that's what the question is. But what are they really trying to do? What do they really want?
Right.
And to be able to answer those questions, you've got to be able to do that, which involves having a particular way of thinking. It's great training because when you have mastered that, it means you can work in a very wide range of areas because you're used to not just jumping in and giving a kind of knee-jerk reaction to a question. You're used to just sort of taking a bit of time and saying, okay, what problem are they really trying to solve here? And what's the best way to try to solve that problem? So to give the client what they really need as well as just what they're asking for.
So that's actually a good way to look at it. So you're saying that learning this, and how long does it take? How long is the coursework before you can be completely passed? And
it varies because most people fail some of the exams. I certainly failed quite a few of the exams on my way to qualifying.
Right.
It's around 6 or 7 years to qualify.
Okay. And so once you've qualified after 6 to 7 years, the core skill that you've developed is being able to identify the problem that the client is looking to get solved.
That and a lot of complex maths. So you not only know what the problem is, you know how to solve it. You know which bits of the technical stuff to draw on to really help them answer the question they've got.
And you also, we were talking about this the other day, you said something that really stood out for me. Why is it important to figure out the question that needs to be answered more than the answer itself?
It's almost like the difference between, if you're a doctor, dealing with the symptoms and dealing with the underlying cause.
Right.
So it's really about finding what the true underlying thing you're trying to solve is, the true question. And I see this a lot in the work that I do in risk management and investment, where, for example, you're trying to come up with the information that a board would need to feel that it's really managing the risks that it faces.
Right.
Because there's an awful lot of risks out there, but which ones really matter? Which ones does it have any control over? That's the kind of information that you want. I mean, you see some risk reports and they've got a whole load of risks in there. Right. It's all very interesting. But for a lot of them, there's not a lot anybody can do about them. So, it's thank you for the information. What do I do with it?
Right.
So it's a case of trying to work out what's relevant, what really matters, what information you're doing that someone can do something with. I mean, the so what test, basically.
Right. Interesting. Is this a career that becomes boring after a while?
Well, it hasn't yet. I've been doing it for over 30 years.
Oh, wow. That's a long time.
So, thank you. It depends what you want. Some people do want a routine career which isn't too stressful and they do the same thing time and time again.
Yeah.
I don't. I like doing new things. I like learning new things. I like new challenges, solving new problems. I started my career in pensions consultancy.
Right.
Moved to investment consultancy. I worked in asset management. I worked for a life reinsurer, helped develop a life reinsurance product for them. I worked as an academic. I was a professor of actuarial science, carrying out research. I've worked advising sovereign wealth funds, central banks, national pension schemes. I'm director of an insurance company. I've done lots of different things, and they've all been very interesting. Well, most of them have been very interesting.
Should a sovereign wealth fund build a brand new city with a 150-mile or kilometer-long apartment complex?
Well, it is. I mean, it is.
And how do you assess the risk of that?
The best way is to break it down into the component risks.
Right.
So if you look at the firms that are doing the work there, so you don't look at the risk of the project as a whole, you look at the risk of the individual components of that project and the firms involved in delivery of those different components. Because at the end of the day, what you've got is the sum of a range of risks, of which any individual one might not be that different from the risk relating to a local car body shop. It's just there's lots of them and on a larger scale. So you deal with it the same way you deal with any other risks. You break it down to its component parts. You look at data. You look for similar situations, similar firms, and you make your calculations.
How would you risk assess a one-of-one? And I'm a car guy, so I have to ask you this, right? So there's this beautiful vehicle. It's a Bugatti Type 57 Atlantic. And then there's another one that I think there's a few of them out there. But recently, Mercedes sold a Gullwing that is a one-of-one. It's got a German name that I always fail at pronouncing. And they sold it at $100 million, which is the highest price ever paid for a car. And they raised money for charity. Whoever bought that car, it's one of one, and it is the highest and most expensive vehicle of its kind. How do you ensure that, and how do you price the risk of that?
Well, the price and the risk, that's fairly straightforward because it's 100 million.
Right.
Because you know the price that was paid. So if you want to...
But it would appreciate, though, because the guy who would want it next is definitely going to pay way more than that.
Yeah, but... there's almost a difference between... Well, there is a difference between insurance and assurance. So, in terms of the ways of thinking about it, so you could think of insurance as being able to put you back in the position you were before. So, your car gets written off and you're insured, you can buy an identical car. Assurance seeks to compensate you for what you've lost. So that's why you talk in the UK at least about life assurance rather than life insurance, because no matter how much your life assurance policy pays out, it's not going to bring you back from the dead.
Right. Okay. So in this case, it would be assurance. You're right. It would not be insurance because you can't replace this.
Yeah. So it would be a case of agreeing with the insurance company a suitable amount that you would be compensated, but then you've got to pay the premium for it. So, if you decide, well, it's gone up, it's actually worth 200 million, you premium's probably going to double as well.
Right.
So, and that's only for a total loss because, if you look at, even though it's a one-off, if you look at what's happening in, say, the warbird world, so looking at Second World War planes,
right,
they will, every so often, very rarely, they will dig out the remains of a crashed Spitfire from a field in Northern Europe. And there's very little left of it at all. But they will rebuild it.
Right.
And they will create a new Spitfire, of which there's very little original left, but there are some parts of it.
Right.
So even with those, and they'll be sold for millions of pounds, but even those, they can be rebuilt. So it might be feasible to rebuild that gullwing, and even if you're not rebuilding it from being a total write-off, if you're taking a nice 100 million gullwing down a multi-story car park and you scrape the front of it on the wall. Ouch, yeah. Or as I've done with cars before, you misjudge the size of a speed bump and there goes the bottom of your front spoiler. Yeah. Ouch. So those can be repaired.
Yeah.
And even for a very expensive car, it is repairable. And the insurance will cover that as well.
Right.
It's not just total loss.
And the same applies to paintings, artifacts.
Yeah.
Would they all be priced? The risk would be priced the same way for everything that falls in that category.
Yeah, and for paintings as well, if you've got a protester throwing paint at a painting or attacking it with a knife, then sometimes they are repairable. So the insurance premium, the insurance payout, will be covering the cost of the repair rather than trying to compensate you for your lost artwork.
But once you repair something like that, is it still considered as authentic as it was before the incident? In your world?
Well, the best way to tell is to try and sell it again and see how much it goes for. But if you're not, you'd assume that the work has been done to bring it back to an adequate standard. Right. And there's kind of equivalents in the car world. If you go, if you scrape the front of your car, you're sort of looking behind your nice car collection there. Yeah. You scrape your Ferrari, and you take it to a Ferrari dealer, and they do the repair. And you can't see any evidence
so that's
of it
considered as good as...
That's as good as new. Mm-hmm. If you take it to...
an independent repair.
Yeah, I was going to say you make it around the corner. So it gets a bit of filler and sort of sands it down and has almost the right shade of red. Right. It's repaired, but it's not quite the same. So there's differences there.
Interesting. What's the one thing you don't like about this career?
The one thing I don't like or haven't liked in the career is I once ended up in a pure client service role where my job was to put together presentations on performance numbers and take them to clients. And I hated it. Absolutely hated it. I lasted less than a year in that job because it wasn't doing what I enjoy, which is something which is at least a little bit technical.
Right.
Doing something which is technical, difficult, new, and then explaining it to people. That's what I enjoy doing.
Interesting. Paul, that was interesting. I never thought about insuring Ronaldo's legs, though there has been news, and I remember this now that you say it. Jennifer Lopez's butt got insured, if it was true. I remember that made the headlines. And I'd love to meet the actuary who worked on that analysis.
Probably just from data, I think.
Just from data. Thank you for the time. And I hope you had a wonderful trip here in Karachi. And I hope to see you again here soon. And hopefully not modeling country risk, but country potential instead.
Well, there's a lot of potential here. It's a great place.
Thank you so much. And thank you all for tuning into DigiTales. Like, subscribe, comment below. I always follow and read your comments and try to bring in guests based on the feedback you share. So keep it coming. Bye-bye.